In the session 6, focusing on estimating cost of debt, debt ratios and cost of capital, Professor Ashwath Damodaran delves deep into the topics and covers all the basics and major nuances very delicately. So Professor first defines what real debt is. It has three traits: fixed payments in good times and bad. Those payments are tax deductible second, and third, if you miss them, you lose control or go bankrupt. So yeah, interest bearing loans count, but so do long term leases, like those massive 10-year contracts retailers love. If you're locked in, that's debt. Now, how do we price that debt? Start with the risk free rate. Add a default spread based on credit risk. Add additional risk premiums associated with the company that may affect their debt component. Now, if the company is not rated by a credit rating agency, then use the interest coverage ratio to compare the synthetic rating for that company by using the table that was given in the videos by Professor Damodaran. Using this table and method will allow you to get a proper credit risk premium. You should add on to the risk-free rate to reach the cost of debt. If the bond is of a foreign denomination, then make sure to properly assess the revenue generated by the company in the foreign market versus the domestic market and use a discount factor to the exchange rate risk as well as the country's default risk. Finally, add up all the premiums to reach the cost of debt pre-tax. Apply the tax shield to derive the actual cost of debt for the company. Some of the nuance points made by the professor were: make sure to clearly classify what is a debt, whether it is a balance sheet item or a non-balance sheet item. Find the market value to determine the actual weights of equity, debt and preference shares. For convertible bonds, break the option and fixed component of the bond and consider the fixed aspect of it for the calculation purposes. Treat the preferred stock separately than equity or debt when calculating WACC. Be careful about the window dressing problem, where a company might list a senior bond in the market, giving it a favorable cost of debt. So that would be all about session 6. Thank you.